This is the Asia Trade. I'm Shery in Bloomberg's Asia headquarters in Hong Kong.
I'm Haidi, Stroud-Watts in Sydney, where the market has just opened. The top stories this hour. President Trump says Ukrainian President Volodymyr Zelenskiy will be involved in peace talks with Putin, countering criticism that Ukraine is being left out of discussions in Saudi Arabia. German Chancellor Olaf Scholz tells Bloomberg that the European Union is strong enough to counter any US tariff threats, but that he hopes for an agreement that avoids a trade war. And Australia is set to ban foreign investors from buying some houses for the next 2 years as part of the government's election pitch as home prices surge.
A lot for investors to digest this week, Heidi. Of course, we do have a few central bank decisions here in Asia, including, of course, in Australia. Also, New Zealand expected to cut rates. We're also watching the Federal Reserve, of course. We have heard from President Trump's top economic advisor, Kevin Hassett, now saying that he'll be holding regular conversations with Fed Chair Powell, regular lunches also with Fed governors in order to discuss the state of the economy. Of course, it was pretty regular during his first presidency. Now we're expected to hear more conversations at a time, of course, where there's a lot of uncertainty over tariffs.
Yeah, and all of that is sort of the overlay when it comes to the inflationary uncertainty and the kind of troublesome scenarios that could come into play for global central banks, right, Shery? And as I mentioned at the top, we heard from the German Chancellor saying that the EU will hit back when it comes to Trump tariffs, and he's threatened these tariffs across steel, across aluminium and other categories of products, but saying that obviously a deal is better, saying that the EU is strong enough to counter any of these tariff threats, but that he does hope for a negotiated agreement that can avoid a trade war. So take a listen to what he had to say.
We act together and we will stick together, which I think is also important. And so I'm quite confident that a good solution is feasible and everyone should work to make it happen.
And we'll be watching those automakers very closely in Asia's trading session this week, especially given that we are expecting those to come as soon as April 2nd, according to President Trump. Take a look at how we're setting up, because the Japanese yen fell for the first weekly loss in about 5 weeks against the U.S. dollar. Nikkei futures setting higher, 0.1%. This, of course, as I mentioned, we do have the RBA rate decision expected to cut the staggered open, not moving a lot at the moment. But this, as we continue to watch the offshore yuan at the highest levels in about a couple of weeks already. Of course, we've been watching those tech stocks and that rally in that market, given the optimism over artificial intelligence and DeepSeek as well. Not to mention, of course, we have heard from the PBOC governor as well, and of course, what that means for the market. Take a look at how we're setting up with U.S. futures. We have been watching the dollar very closely, falling to the lowest levels already this year. NASDAQ 100 futures not doing much early in the Asian session. Of course, we do have U.S. markets away on a holiday on Monday for President's Day. Crude prices under a little bit of pressure, but still above that $70 a barrel, Heidi.
And geopolitics is front and centre as we kick off this week in Asia, Shery. President Trump saying that Ukrainian President Volodymyr Zelenskiy will be involved in peace talks with Russia. It comes as senior US and Russian officials prepare to meet in Saudi Arabia to discuss a potential leaders' summit to end the conflict. That's bringing up Bloomberg News editor Michael Heath. And of course, there's been so much a criticism, even sort of back in the presidential campaign, that Trump is going to perhaps go easy on Putin and kind of, hand them the better side of a negotiated deal.
Yeah, I'm not sure that it looks too different to that at the moment, Heidi. I mean, there are these talks, as you mentioned, in Saudi Arabia. There's sort of preparatory talks between the Russia and the US side. And as you mentioned, President Trump did say that Ukraine and Volodymyr Zelensky will be involved. The question is in what form, because so far it sort of looks like Europe has been kept out kept in the cold. Ukraine is finding out things sort of after they happen. So it's going to take a little bit of a turnaround here to sort of reassure Ukraine that a deal is not going to be done over its head. But one interesting thing is that Volodymyr Zelensky was talking fairly tough. He said, look, there'll be no peace without Ukraine being involved in it. The Ukrainian people themselves won't accept that, and I think that that's completely correct. And Europe, of course, is trying to sort of scramble to get itself into the discussion here, so it's not left out as well. So it's a really interesting time. It's been incredibly fluid, quite a few contradictory statements coming out, but from the Ukrainian side, that they weren't terribly promising. It just looks very much like this whole relationship between President Putin and President Trump is sort of rekindling. It's very opaque. No one quite understands what it is. Trump seems to have a very, very high regard for Putin. I mean, even to the point where when he was mentioning that Zelenskiy would be involved in it, he said that Putin had told him he didn't want to go any further in the war and that he's sort of ready to end it. I mean, these not the sort of comments that you rebroadcast because, you know, you wait until you've actually got things set in place. So, yes, it's going to be really interesting to see how he handles it.
Are we seeing European leaders respond to this, you know, changing geostrategic and security environment and demands by the US?
Yeah, I mean, definitely. It looks like it was quite a historic weekend, really, in terms of the whole transatlantic alliance here, because we've got this meeting today that convened by President Macron, and the European states that are involved are the ones who actually do take their defence spending seriously, plus Germany, which doesn't quite so much. But nonetheless, it's all states involved who can do something, and it looks like they're trying to bring in a core group who can actually come up with some sort of plan quickly to allow Europe to respond to this. Countries like Denmark, like Spain, France and Britain obviously as well, Poland, all countries that can get moving. Now, we saw some smaller states criticise this, but the problem with the EU is it's so unwieldy, and the Trump administration is moving so quickly that Europe must respond quickly. And I think the Trump administration does have a very strong point on Europe. You know, it's been free riding for 80 years. It really does need to step up. It's just that it comes in the context of a war, which makes it very, very difficult and stressful to do, obviously. But the underlying premise is right. It's just whether the timing is. But yes, it looks like Europe is really going to make a change here.
Yeah, and the Trump administration really wants to get paid back, is what they are saying right now when it comes to supporting Ukraine on the Russian invasion, but at the same time not having necessarily invited President Zelensky to these negotiations. How is this going to play out?
Yeah, Shery. I mean, there was when the Treasury Secretary was in Kiev last week, he presented an economic proposal to the Ukrainians about these critical minerals that Ukraine has, and it looks like. It doesn't look like it's particularly good for the Ukrainians, this agreement. From the bits that we've seen or heard or have been reported about it, it's that the US will get 50% of whatever Ukraine has. And number one, that sort of contravenes Ukrainian law, but it's sort of almost like dare I say, an imperialist sort of thing that a larger state takes some of the economic power of another state. Ukraine's happy to deal with the US in and to be very, very generous on it, but Ukraine needs security guarantees tied to that, and there were none here. It was just US will have this ownership with no, it won't have any requirements with in terms of defending Ukraine. Now, the Trump administration says, look, the fact that the US is in there means that it will defend Ukraine because it's got an economic stake in it, and they're very, very strong on Ukraine needing to pay for what the US has done to support them. And it's a difficult issue because if you look at it from a macro level, the reason that the US was doing that was so they don't have to deal with Russia in Europe at some point down the track. So it was sort of an investment, in stopping this before it makes it worse. But we'll just have to see how that unfolds. Ukraine is not agreeing to it yet, but it may have little choice here.
Bloomberg News editor Michael Heath there as we continue to watch those geopolitical developments. And other stories that we're following on the other side, Israeli Prime Minister Benjamin Netanyahu has threatened to open what he called the gates of hell on Hamas if all remaining hostages aren't released. Netanyahu told reporters after meeting U.S. Secretary of State Marco Rubio that Israel was in full cooperation with the U.S. with a common strategy in place. Following the release of 3 hostages on Saturday, President Trump said he will back any decision Israel makes post-deadline for all captives to be free. President Trump has asked the U.S. Supreme Court to let him fire the head of an independent agency that protects government whistleblowers. He's seeking the removal of a temporary restraining order that currently shields U.S. Office of Special Counsel Hampton Dellinger from being removed for 14 days. Meanwhile, the Department of Health and Human Services laid off employees across several agencies over the weekend, including the Centers for Medicare, the FDA, and the Centers for Disease Control.
Shery, we've been watching Star Entertainment, of course, as it continues to sort of languish in this increasingly precarious financial situation. We had earlier reporting over the last couple of days that Oaktree Capital Management is trying to buy out Star Entertainment's lenders. It is sort of understood to be the last roadblock to the board appointing voluntary administrators, I should say, to the group as it looks for further lines of liquidity. We are now hearing in a filing from Star Group that they have received that debt refinancing proposal from Oaktree to offer 650 million Aussie dollars in loans across two facilities. The board for Star will consider that Oaktree proposal, and this is a proposal that will be dealt with in facilities over 5 years. No certainty that the proposal will be progressed, but that Star will continue to explore possible liquidity solutions, I should say. So clearly that has made its way to the board. They'd earlier hired FTI Consulting because it became quite clear that neither shareholders or lenders were willing to extend yet another lifeline. We had earlier reported that Star was also in talks to sell 50% of its Brisbane complex to its Hong Kong-based partners, but those offers did not proceed at this point as well. So quite a parlous situation for Star Entertainment, but we're hearing that this could be a lifeline from Oaktree Capital being considered. Well, coming up on the Asia trade, why German Chancellor Olaf Scholz is confident that the EU can counter any US tariff threat. Hear more from our exclusive conversation next. And also ahead, we'll be discussing the economic impact of Trump's tariffs and the broader outlook when it comes to Asian central banks with HSBC. JPMorgan Asset Management will also be weighing in on China's AI-driven stock rally. Plus, we take a look at Beijing's position when it comes to the war in Ukraine and other takeaways from the Munich Security Conference. This is Bloomberg. German Chancellor Olaf Scholz says the European Union is strong enough to stand up to President Trump's tariff threats. Even so, Scholz says the EU is open to talks to avoid an all-out trade war. He spoke exclusively with Bloomberg on trade as well as Germany's spending on defence and Ukraine.
First, I have to admit that I'm in favor of free trade. I think this is a big advantage we have in the world, and that many of the wealth and the growth we have in the world is because of free trade. So it must be fair free trade, yes, but free trade is better than tariffs and protectionism. I don't think that this will work.
So it should lower tariffs?
When it comes to the European Union, I think everyone knows that we are a big economic area with a lot of strength, where policy about tariffs is something that is our common policy. So we are strong enough to react to everything that is harming European economy. But we should react always, but in a way that is always offering the chance for an agreement, because it's better for all parties involved, especially on the both sides of the Atlantic.
But is the European Union considering cutting tariffs before any announcement on cars?
We invite the United States to discuss with the responsible authorities about what we can do for a better progress that serves all of us. There is a willingness, and so I'm sure it's better if we agree to something that helps all of us. And it is good to know that Europe is strong enough to act and to react.
You talk about it being a common project, but Donald Trump has made clear that he wants to do reciprocal tariffs. He doesn't want a WTO approach where all the rules are on the same countries. And even with the European Union, he might want to have a different tariff regime for France and Italy and Germany. What would you do then?
The European Union is a unified economy and has...
but there's nothing to stop the US doing that.
But it has common tariffs, and we act together, and we will stick together, which I think is also important. And so I'm quite confident that a good solution is feasible, and everyone should work to make it happen.
You spoke this morning very clearly about what you need to do to increase defence spending above 2% of GDP, and suspending the debt brake just for that additional defence spending. But for many countries, it will want to also have joint debt issuance for Europe as a whole to be able to invest enough in defence. Would you consider that, given everything that's happened in the last few weeks?
I think there are three things we can do in this very moment. The first is that we agree in Germany that supporting Ukraine is something of an extra effort. So we should have extra room for maneuver, also financing this support to Ukraine, which, when it comes to the figures, Germany is doing the most. We are the biggest supporter of Ukraine in Europe, the second biggest in the world, and this has to continue, but we cannot pay for it with cuttings in pension schemes or in the health sector or in cuttings in the investment into streets and railways and so on. So I think it's clear that we have to do this. And the second is that we have to agree how we will continue with the spending of more than 2% of our GDP for defense, which we achieved because of an extra fund which I managed to get through the parliament. But for the future we need a new decision about this, and this is for continuing with this 2% plus already 30 billion a year. So also this will not work with tax increases or cuttings and spending in the different areas of the German budget. And when it comes to do more, which will be obviously necessary when we look at what NATO is discussing, then it especially means that we do something for these activities, which gives us in Germany the opportunity to spend even more, and this has also to do with the reform of the debt regulation in Germany. When it comes to Europe, I think we should help every country, if it spends more than 2%, to be not hindered by the European regulation on treating debt.
So changing the stability.
We have to change these agreements so that this is feasible for a country to do.
German Chancellor Olaf Scholz speaking exclusively with Bloomberg's head of economics and government, Stephanie Flanders. Now, our next guest says that all the tariff uncertainty in itself is already bound to have an impact on Asian economies. Joining us now is Fred Neumann, Chief Asia Economist and co-head of Global Research Asia at HSBC. Oh my gosh, Fred, good to see you in person after all these years.
Yeah, all these years. You were, what, New York, Japan? You know,
I missed you in Japan when you were visiting.
You, yes.
No, but I mean, what a time right now, right? I think the last few times I spoke to you, we also had this Trump tariff uncertainty. We're back to that. Did we get any lessons from the last round of tariffs we had in 2018, 2019?
You're right. It's a bit of a déjà vu, but I think you have to be careful to say that it's exactly a rerun, right? The global economy has moved on. There's much more inflation in the world now than it was back in Trump 1, right? There was, in fact, we talked about deflation risk back then. Now it's inflation. So it might be much more disruptive in many ways. It might also be, we're going to see more countries actually receive tariffs this time around. Back then it was mostly China, and now it's sort of, are we going to get reciprocal tariffs on everybody?
Reciprocal tariffs. They're now talking about auto tariffs as soon as April the 2nd, I think. What does that mean in terms of central banks? As you say, there's the inflation concern as well.
So up until now, central banks in Asia have been really worried about the stronger dollar, right? They kind of knew they had to cut because inflation is back down, but they're kind of reluctant to cut because they don't want the currency to weaken further. Now, you sense they're really getting concerned more about growth. What does all of this mean for economic growth, and should we therefore cut? I.e., the reaction function is sort of switching from the currency towards growth, and that's why we might see more cuts coming.
If you have the tariffs in place, what does that mean for economies across Asia? Because at the same time, we could see those inflationary pressures, but what happens if the U.S. economy starts to slow down? We saw the U.S. retail sales also being much softer than expected.
Well, it was primarily the U.S. that imposed tariffs. Actually, you could argue it's deflationary for the rest of the world. So what you get then is a divergence of inflation. You have more inflation in the U.S. because of the tariffs, but everywhere else, because there's weaker growth, you might actually get less inflation, and therefore central banks have to, have the door open to cut. The only thing is that the currency might weaken, and so do you accept that or not? At some point, you probably prioritize growth over weaker exchange rates.
And, this time around, the Chinese economy is in a far worse state than the last Trump administration, right? So what tools that are meaningfully effective are still available to Beijing?
Well, if you talk about protecting economic growth, then it's really about firing up domestic demand, right? That's got to be one of the priorities, because the export channel really is not going to be viable for the next 2, 3, however many years. It's all about the domestic economy. So one of the first reactions is to say, okay, well, tariffs are coming. Well, what are we going to do with growth? And it's about fiscal policy. It's about putting in more stimulus domestically. But as we know, it's been slow in coming. We're now looking to the 2 sessions in early March. Is there more going to come? It might be more of a very gradual, incremental kind of move forward. It won't be the big bazooka that many people are still hoping for.
The domestic demand side, the animal spirit side, has been missing this whole time, right? Do you think it's because they haven't been willing to kind of go for the big guns like direct household payments, and do they need to do that? What breaks this, deflationary mindset and confidence spiral?
It's probably, you could always say you need more, right? You could say, well, interest rates should be cut more. You could say that we need more fiscal stimulus. And to some extent, that's true. We probably need more of a policy accommodation. At the same time, remember that one of the key drags on the economy is the property market. It is that worries around property values that's really starting to weigh in the confidence of consumers. And so you probably want to kind of hone in on the property sector in particular. So the key to unlocking things is probably to accelerate stabilization measures on property, and therefore then hopefully at that point when you do stimulus, then you have much more traction with it. So we would expect actually priority coming months needs to be the property sector, and here probably we need more Beijing funds to help stabilize things, because there's still excess inventory in the system. There's still companies that are struggling a little bit with funding, and so that's going to be sort of one of the keys to unlock things.
Talking about animal spirits, are they sustainably back over in Japan? I mean, we've known that there's been a lot of interest on Japan, especially with the BOJ finally normalizing rates. But at the same time, how sustainable is this if we continue to see inflation picking up and consumers suffering because of a weaker yen?
It's a really fine line the BOJ has to walk, right? You want inflation, you just don't want too much. You want optimism, but you don't want to raise interest rates too much. So it's really a fine line. So far, I have to hand it to them, they've really struck the line very well. If you look at... Yeah, I think so far it's worked actually quite well. It looks as if inflation expectations are back up. We see corporate earnings actually doing reasonably well. These are large companies. Investment is coming back. We're seeing moves towards accelerating productivity. Likely we're going to get another round of strong wage growth. So it really looks like Japan has turned a corner. Now, that might work for 1 or 2 years. The problem is what comes after, right? And there we need to see, how do we kind of ease the decline in population? How do we really start to get those productivity growth going in terms of innovative technologies, in terms of new industries? That's still going to be a big hurdle. But for now, I think they've really laid the path for a sustained recovery.
Yeah, we have fourth quarter GDP numbers coming up in a few minutes. Fred Neumann, good to have you with us and good to see you in person again. Chief Asia Economist and co-head of Global Research Asia at HSBC. We have more ahead. This is Bloomberg.
Take a look as we set up for a pretty cautious open here in Asia, given all of the tariff, trade and geopolitical headwinds that we're watching. The dollar swings that we're seeing have been having an impact when it comes to yen bulls. There's a lot of more European-based trades there. The yen really looking to the GDP numbers. The Aussie is looking to the RBA decision this week. But we're watching the euro very clearly. It's a major reason why the Bloomberg dollar index is down year to date. We do have the German elections on Friday as well. This is Bloomberg. Take a look at some of the early movers. We're just about half an hour into the start of trade here in Sydney. Westpac is one that we're watching the profit dipping as we see kind of that challenging rates environment for clients from the CEO there. We saw unaudited net profit for the 3 months ended last year, end of December, I should say, coming in at just over 1.1 billion US dollars there. We saw hedging contributing to the bulk of that decline, but also seeing some improvement when it comes to borrowing finances. Star Entertainment is the other one that we're watching, seeing quite a bit of upside actually extending to those session highs as we heard confirmation that they did get a debt refinancing proposal from Oaktree Capital, that the board is considering that. This is to the tune of 650 million Aussie dollars of debt for the beleaguered casino operator here. We're also watching BlueScope Steel up by almost 11% at this point, the most since 2020 after a beat on those earnings, the highest level since September 2021. Well, Australia's government will ban foreign investors from buying established houses for the next 2 years as part of an election pitch to tackle surging home prices. For more, let's bring Bloomberg's Paul Allen and Bloomberg Economics Australia and New Zealand economist James McIntyre. So, Paul, what did we hear?
This was an announcement from the Housing Minister, Claire O'Neill, on Sunday. It's only going to apply to temporary residents, but it would mean a ban that they will not be able to buy houses starting from April this year for 2 years, taking us through to March 2027. And during that time, the government will have a review and consider whether or not to make the ban permanent. Of course, we talk a lot about how unaffordable houses are in Australia. Just here in Sydney, prices are up 70% in the past decade. So we've got a median house price of 1.2 million Aussie dollars. That's about 750,000 US. So obviously, a lot of young people living in the city and elsewhere around Australia are really, really worried that they're never going to be able to buy a house. So it makes it a really hot political issue. But are foreign buyers really the problem? And we'll get James to unpack this a little bit more for us, because there's a whole range of factors here. Is it supply? Is it negative gearing, the very weird and generous tax break that we have here? So we've got to view this through the lens of an election, which is going to be called before May 17.
Which is why, James, the reaction has been a fair degree of cynicism, right? Is this going to fix the housing affordability crisis?
Well, no, it won't. And that's just straight up. This is something for the electorate. You're targeting foreign buyers who were already severely constrained anyway. The only remaining ones that were able to buy established properties were those people that were here on temporary visas or were other visa classes and students. And so what we're doing is that we're only talking about the last year we have figures for about $5 billion worth of purchases. Really nothing. 2/3 of the foreign investors were buying new properties, and this is just going to shift another $5 billion of demand potentially into new properties, which is what the government would like to see from a supply side. It really won't do anything for prices in a big way. The only way the government's really going to get something done on the affordability of new housing is to bring down the cost of supplying new houses to the market and supply a lot of them, and this definitely won't do that.
So, James, also, wherein property prices are already falling in some cities, so can we just understand this as an election strategy at this point, just for show?
Well, look, that's also an interesting point, although Paul did raise that we highlight correctly that we have seen a very strong run in especially Sydney house prices over the last few years. However, when it comes to Sydney and Melbourne, two cities where there is a more hotspots for international students and foreign investment, prices in these cities have actually been falling. Sydney over the last 4 months has recorded declines in house prices. Melbourne house prices have been falling for the better part of the past year or 18 months. So these are not housing markets where there's a lot of froth. That's some of Australia's other capital cities right now. But at the end of the day, we're not going to be taking a lot out of these markets as well. They're already quite weak. This would weaken a little, but if the RBA delivers 25 basis points, as we expect tomorrow, and then pursues a set of cuts over the course of the next year, that could be something that works in the other way in terms of, even though foreign demand, a small amount of it being taken out, but domestic demand armed with rate cuts could see this come out in the wash.
Paul, we're already seeing a lot of pre-election posturing, and the date hasn't even been called yet, right? It's looking like it could be quite a bruising campaign for the Prime Minister.
Yeah, it's looking very close, and the tactics are starting to suggest that as well. As I said, you've got to look at all these policy announcements through the lens of the election. We're seeing a huge resurgence in populism around the world. Populism, one of the features is framing out groups for all of your problems. Foreigners buying up property, boom, that's populism Australia style. So this was a coalition policy that's now been co-opted by the Labor Party, and all you've got to do is look at the polls and how tight they are. The latest YouGov poll suggests this is going to be a one-term government. The coalition would be able to govern perhaps a minority. Peter Dutton would be the Prime Minister. So the coalition's in the driver's seat here. When you see these sorts of policies getting co-opted and recirculated, facts as outlined by James don't matter. All that matters is, does the message land? We're going to see.
Sorry, James. Bloomberg's Paul Allen and James McIntyre there. Shery.
Right, Heidi. Over in China, hedge funds have been piling into Chinese equities at the fastest pace in months. This as we see bullishness on the DeepSeek-driven technology rally, adding to hopes for more economic stimulus. For more, let's bring in our China correspondent, Min Lo, here in Hong Kong. And Min, so exciting to see you in person for the first time.
Yes, I know. Glad to be here and have you in the Hong Kong office.
The last time I was in Hong Kong, we were talking about how China was almost uninvestable. Then there was a little bit of fear of missing out. But this time, given that it could be all about DeepSeek and cheaper AI models, could this potentially be sustainable?
Yeah, I think there is still a lot of concern, especially from investors that have been burnt before by the failed rallies of the past. There is also the concern around U.S. tariffs and what that's going to do for the Chinese economy, and also, of course, that long-standing concern around the monetization possibility for many of these emerging AI technology. But it does feel like, just from the market chatter, there's this sense that maybe China is back, that there is a fundamental reevaluation of the investability of Chinese stocks. And you take a look at how much the Hang Seng Tech has moved, again, fueled by that surprise of DeepSeek that has seemed to convince investors that, yes, China does have those companies that could form a vital backbone to these AI ecosystem despite the tech race with the U.S. And, of course, the valuations play a part as well, because MSCI China is trading now at about 11 times forward earnings compared to 21 times for MSCI India. And you can see on a chart that we'll pull out that China is actually, the MSCI China has been beating its Indian peer for 3 consecutive months, which is the longest such streak in 2 years. And a lot of this rotation is coming at the expense of India because of worries over the macroeconomic growth of India, the corporate earnings slowdown there as well.
That's really interesting, because India for a while was the alternative to China,
exactly.
Right? And there seems to be perhaps some warming up when it comes to Beijing and President Xi Jinping with tech leaders like Alibaba's Jack Ma and others.
Yeah, that's also interesting to watch, and this is according to Reuters reporting and our own sources as well, suggesting that President Xi is going to have a meeting today with many of these tech titans, the founders of Alibaba, Tencent, DeepSeek, among others, Xiaomi, Huawei included as well. And I think it's interesting. I think the symbolism of it is particularly significant, given that Alibaba's Jack Ma is attending as well, and he is arguably one of the most prominent faces who have suffered under that multi-year crackdown on the tech sector. His financial company Ant's IPO back in 2020 was pulled back abruptly by regulators after he criticized regulators. Interesting to watch what would happen at that meeting and what state media would report of it, because the first time President Xi had held such a symposium was back in 2018, and that's when he pledged tax cuts and more support, more financial backing for the private sector. So perhaps a signal here that the government is recognizing the importance of the private sector in fueling this disruption, the innovation for the economy, and changing its relations towards the private sector as well.
The latest from the corporate front now, and Bloomberg has learned that TSMC is considering taking a controlling stake in Intel's factories at the request of Trump administration officials. Sources tell us that the deal would have TSMC fully operating Intel's US semiconductor factories and would address concerns about Intel's deteriorating financial state. TSMC is said to be receptive to the idea, but it's still unclear whether Intel is open to a transaction. Elon Musk's AI startup xAI will release its Grok 3 chatbot with a demonstration on Monday. In a post on X, Musk described the product as the smartest AI on Earth. Musk has said that the model can reflect on mistakes it makes by going back and forth through data. Grok 3's debut comes as more and more competitors emerge to challenge OpenAI's ChatGPT. Bloomberg learning that Apple is planning to add AI features to its Vision Pro headset as it seeks to boost interest in the device. Sources say it's aiming to roll out the upgrade in April, along with an updated mode for guest users and a spatial content app. Apple is expanding its Apple Intelligence to the headset, just as Google announced its mixed reality operating system that integrates its Gemini AI. Shery.
Take a look at how we're trading and setting up for the broader Asian session, with the ASX 200 right now in early trading being led lower by financials and energy stocks. Of course, we have several earnings. Westpac's profit, for example, dipping, so do watch out for that. Singapore Nikkei futures at the moment not doing much, but this after we saw the Nikkei fall on the Friday session, and we're contending with a Japanese yen that has seen the first weekly losses in 5. And do watch out for JGBs when trading starts, because they've been under pressure in the 10-year yield really at multi-year highs. U.S. futures also not doing a lot, but remember, we're trading near all-time highs. U.S. markets will be closed on Monday for President's Day, but we'll be watching Treasury futures as well, because we did get some soft retail sales reading. And of course, we continue to contend with President Trump's tariff threats. We have more ahead on the Asia Trade. This is Bloomberg. Bloomberg Economics sees Japan's GDP growing at an annualized pace of 2.6% in the fourth quarter. That's above estimates of economists surveyed by Bloomberg. Senior Japan economist Taro Kimura joins us now for more on this. And Taro, the economists surveyed by Bloomberg thinking that growth would be around 1.1%. So why are you expecting such strong momentum?
There are various factors. Of course, private consumption will remain as solid as very solid readings in the previous quarter, as well as increased capex despite the BOJ has been increasing interest rates. Also, the tricks in my estimate is the smaller imports, which will buoy the GDP reading, probably because of the pullback from the previous quarter's big import for, I think it's a newly launched smartphone, probably the iPhone 16. So this will add the gloss. So in total, with a solid domestic demand, with in addition to external demand and some tricks from the fewer imports, I expect a very solid reading, which will make the Bank of Japan happy.
We've seen record prices when it comes to rice and the like in Japan, right? What are we seeing in terms of food inflation, and how quickly could it change the inflationary picture for the BOJ?
Yes, I think the CPI reading on Friday is more important for the BOJ's policy decision than the GDP. And recent price picture shows actually Japan's deflation or disinflation is already in history. And the service inflation has been picking up with reflecting the solid wage growth. And what is more, as you mentioned, the spike in food prices, that's probably reflecting the structural factors such as labor shortages in farms, as well as more frequent unseasonable weather. Those factors actually make the rice prices, Japan's staple for the diet, increase more than 50% year on year. I think the BOJ is alert that such a spike in the food prices will increase the households' inflation expectations, and they should be alert to the risk that the inflation will consistently overshoot its 2% target.
Taro, how about the risks of external shocks? We hear that Japan has been asking the U.S. to be exempted from reciprocal tariffs, but of course, the U.S. at times hasn't been too happy with Japan's trade surplus against it. What are the implications if we see more of these tariffs affecting the economy in Japan?
Right. Of course, the Trump's tariff is the biggest risk, particularly if he imposes tariffs on Japanese car imports from Japan, because it's the largest industry in manufacturing. I think the Prime Minister Shiba is strategically try to woo Trump by pitching Japan is the largest investor, foreign direct investor to the United States, as well as Japan's trade deficit is actually shrinking. No, it's very minimal compared to what we had back in 1980s or 1990s. Therefore, I think the Japanese authorities are trying their best to ditch the Trump pressure, but if the tariff is imposed on Japan's cars, it will influence a lot of sectors, not just about auto sector, but given that the auto sector is stalling, that will influence broader sector and probably throw a wet blanket on recent positive momentum eventually happening in Japan for the first time in 30 years. So we are concerned about the Trump is absolutely a big risk to Japan's growth.
Bloomberg senior Japan economist Tara Kimura there. Well, our opinion columnist Daniel Moss believes it's time for the Japanese government to admit victory on deflation. Let's bring in Dan for his view in terms of why it's so hard for Japan's leader to say that deflation is over.
Well, Heidi, there's probably a certain amount of bureaucratic inertia at work, and there's probably a healthy dose of, hey, oh my God, what if this really is another false dawn and we slide back into either deflation or an inflation rate that is so low, it's at risk of returning to deflation. Now, as my colleague Gregory and I have written, anyone who visits a Japanese supermarket these days, as Gregory frequently does, would be amazed to hear from the country's leader that the biggest threat facing the country is deflation. For most people, they would say, wow, hey, we're just psychologically adjusting to inflation after decades of being told that the opposite is the problem. And you've got a CPI which is at or above the central bank's target. You've got interest rates going up. Neither of those things happen when you're in deflation. This just suggests that the LDP hierarchy is way out of touch with what's happening on the ground.
I also don't understand the strategy, if there is one here, for politicians, because wouldn't you want as a politician to tell your public that the inflation that's happening right now is not that you're not to blame for it? One easy scapegoat could be the Bank of Japan is not hiking when it should. So what is stopping Prime Minister Ishiba from actually declaring that, you know, deflation is over, that we actually need to tame inflation and buy some political points from the general Japanese population?
Well, I guess it's tough for any politician to run around saying, yay, we've got inflation, and, we need to make sure we have this current rate of inflation. Really what needs to be done is the case needs to be made, look, if inflation is too low and if we have deflation, that might sound cool because you can get more for your money. However, it suggests anemic demand and it suggests a lack of confidence about the future. So, there might be a communication issue here. Look, no Japanese politician, given the LDP's subpar result in the recent election, wants to run the risk of a George W. Bush moment on the deck of the aircraft carrier saying mission accomplished.
Bloomberg Opinion columnist Daniel Moss. So we do have those Japan GDP numbers just crossing the Bloomberg at the moment. We're seeing nominal GDP rising 1.3% quarter on quarter. The estimate was for 1.2%. We are seeing that headline GDP number growing 0.7% quarter on quarter against an estimate of 0.3%. On an annualized basis, we're seeing a gain of 2.8%. The estimate was for just over 1%. So a beat across pretty much every comparison. Net exports adding 0.7 percentage points to that quarterly GDP number. Business spending rising by 0.5%. That was a little bit softer quarter on quarter than expectations. And private consumption just barely rising, 0.1% quarter on quarter, but the estimate had been for a slight contraction as well. So you're seeing that impact when it comes to the yen gaining versus the dollar after the GDP number came through there as well. So Bloomberg Economics had expected an annualized 2.6% growth. This is a little bit stronger there, but we have been expecting the likes of service exports, inbound tourism, for example, making very solid gains and contributions. Lower imports, though, may have been the rise in net exports as well. But of course, as we heard from our Japan economists a little bit earlier, it really is the picture when it comes to CPI in particular. The contribution to food prices is perhaps more influential at this point. We can catch Japan Ahead every Monday at 8:40 a.m. if you're watching in Tokyo. Subscribers can also watch live on the terminal using the TV Go function. This is Bloomberg.
Take a look at the Japanese yen, a little bit of a spike after we got the Japan fourth quarter GDP numbers. Annualized growth of 2.8%, beating economists' expectations by a lot, growing for a third straight quarter. We have seen service exports, revenue from industrial licenses, inbound tourism, likely really adding to those solid gains, despite the fact that we do still have inflation and that could be hitting consumer spending. But we have seen now fourth quarter GDP numbers growing more than expected, 2.8%. We are expecting January CPI reports to come out later in the week as well. That's said to be pretty hot as well. On the other side of the trade, of course, we have the U.S. dollar as well, and the weakness there perhaps also helping with that boost for the yen. We have seen it fall to the lowest levels this year. We had soft retail sales reading in the U.S., and that's revived bets on Fed rate cuts. It slumped in January by the most in nearly 2 years. I'm talking about the retail sales numbers. So now money markets back to fully pricing in a first Fed reduction by September, Haidi.
Shery, it really is about that inflationary outlook and what the implications are from a potential trade war globally. But take a look at how we're setting up for the rest of major markets opening across Asia. We're seeing quite a bit of downside when it comes to Sydney stocks. The ASX 200 really being dragged down by broad falls across the financial sector. We're seeing shares of Westpac after it said in a quarterly trading update that profit slipped. But we're seeing sort of broad pressure across that market. But having said that, Australian stocks have been trading at repeated record highs there. Taking a look at US futures, they're looking pretty positive as we continue to see the S&P 500 finishing last week within points of an all-time high. So certainly investors in US assets continue buying despite the risk of these tariffs. Nikkei futures looking unchanged, but we'll see if there is that reaction given the better than expected economic data with the GDP numbers that just crossed the Bloomberg earlier. But the market opens in Seoul and Tokyo are next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens and, of course, bracing for a few central bank rate decisions this week, including Haidi, the RBA, RBNZ expected to cut rates, but also, of course, President Trump's tariff threats, and now on automakers expected as early as April 2nd.
A brace position seems to be kind of standard at this point, right, Shery, particularly when it comes to these huge trade, geostrategic developments as well. We're seeing quite a bit of action when it comes to Europe. So watching the euro really closely this week, given we did hear from the German Chancellor saying that, look, they would prefer a deal, but the EU is strong enough to counter any of that Trump tariff threat.
Yeah, take a look at how we're setting up for the Japanese Open. Of course, those automakers are what we're watching, not to mention semiconductors, anything that could be really hit by these tariff threats. Right now, we're seeing the Nikkei Open. We will wait for the Open as we're looking at the Japanese yen right there at 152 against the U.S. dollar. A little bit more strength against the greenback right now after we saw those fourth quarter GDP numbers annualized 2.8% growth, which is much higher than economists had expected. The Nikkei now opening down down 0.2%. As we were watching the 10-year yield, because we had already seen yields rising in Japan with expectations of the BOJ continuing to hike rates. We're seeing it at those highest levels since 2010. Take a look at how we're looking in the South Korean market as well. We have not seen a lot of movement with the Kospi and the Kosdaq. The Korean won still 1440 against the U.S. dollar. But again, it's the automakers, of course, South Korean automakers very exposed to the markets in Mexico, in China, and those tariffs that could come as early as April 2nd. For example, Hyundai Kia's U.S. imports are about 60% of their business or so, Heidi. So we're expecting some big moves in this market as well.
Take a look at the moves, Shery, that we're seeing when it comes to the Australian market. This, of course, a really momentum week when it comes to central bank watchers here. We see Australia set for the first rate cut since 2020 as these domestic growth concerns continue to mount and the global trade concerns and the impact on the trade-exposed Australian economy continue to mount there as well. So that is the expectation going into the RBA meeting. We are seeing quite a bit of downside there as this market is really coming off those record highs that were almost repetitive in last week's sessions, right? We're seeing financials seeing that broad decline across the ASX 200, really being led by the losses that we see in Westpac. Those profit numbers in the quarterly trading update are not particularly positive there. The Aussie dollar, though, 63.57, so what we're seeing, the moves in the euro largely driving what we're seeing as a bit of downside in the US dollar at this point, when watching treasuries as well as sovereign bonds in Australia and New Zealand. Aussie bonds are inching up after we saw the gain in treasuries on the back of those US retail sales numbers that triggered the rally across US bonds on Friday.
Heidi, let's bring in Tai Hui, APAC Chief Market Strategist at JPMorgan Asset Management, for his views of where the markets go from here. Tai, really good to see you in person after all of these years.
Great to be back.
No, but tell us a little bit about where we're expecting trading to go this week, because there are a few different catalysts.
Yeah, I think a few things. First of all, I think the Fed is still very much on hold for the foreseeable future. Some of the inflation data, the growth numbers seems to be in pretty good shape. So I think that could set the tone from the US side. I think in APAC, I think the China AI story is still continue to develop. I think you're starting to see a lot more tie-up between AI companies and potential users and applications, and that could continue to fuel that optimism in the market, especially the fact that, there were reports of President Xi meeting up with a number of tech giants. I think if you think back to 2021, when a lot of the changes in the regulatory framework really impact on the tech sector, there were questions of whether, these tech companies can continue to grow at a rapid pace. But now it seems like there's a new lease of life. Hopefully that could change.
I was going to ask, do you see this as a meaningful fundamental change in how people regard China? Because so far, after the pandemic especially, there was some fear of missing out, FOMO moves into the Chinese market, but none of that was necessarily sustainable given the property problems. Could this be the game changer in terms of tech and their value?
So I think last year we're hoping for two things. One was the macro data or macroeconomy to improve, and frankly, that's going to take time, especially because of the property market. The other one is whether the corporate sector can find some new growth engines. I think this AI story is helpful to build that growth, EPS growth story once again. But of course, it's still very early days, and it remains to be seen how companies, for example, automobiles, e-commerce, et cetera, pharmaceuticals, are going to make use of this technology. But I think at least the direction of which is giving people some hope.
Because companies like in the e-commerce space and other sectors, of course, face the ultimate problem of potential tariffs on them, right? Broadly in the Asian market, is there anywhere to hide?
I think intuitively you think about India or Southeast Asia, but frankly, if you look at the market performance year to date or since President Trump's inauguration, these so-called safe haven markets have not done particularly well. I think partly because the tariff measures coming in, especially against China, has been smaller than expected, and there seems to be quite a lot of room for negotiation. So I think from that perspective, first of all, market was pricing in a very poor scenario for China if President Trump were going to impose 6% tariff. Right now, 10%. But at the same time, the growth momentum of earnings in China could well see some new lease of life. I think that, to me, explains a lot of the divergence in performance within Asia. Frankly, it's not been as expected under the tariff risks or trade war scenario. But at the same time, a lot of things are moving, also a lot of factors are driving market performance on top of the tariff discussions.
Do you stay in the tech export markets, the likes of Japan, Taiwan, obviously, but perhaps also Korea?
I think so. I think if you look at the ultimate demand for data centers, for GPU, et cetera, those remains very much intact. Yes, you could ask the question of whether the top-end GPUs will still be in demand. Well, it will be growing as quickly as people were hoping for. But if China were to join in this AI race, I think that there's still very much strong demand for semiconductors and associated technology equipments. So from that angle, the long run, I'm still optimistic. I think Taiwan may need a little bit of a breather after 2 strong years of performance, but markets like Japan, South Korea, we've already started to see some catch-up from that perspective.
What do you like when it comes to fixed income? How sort of diversified do you want holdings to be in this uncertain environment?
Well, if you're looking at government bonds, for example, U.S. Treasuries, I would prefer the short end of the bonds because ultimately inflation risks is still very much there. So the volatility in the duration, the bond price could well be quite significant on the long end. So you want to avoid that. But at the same time, we're still expecting the U.S. economy to grow at least very much for the first half of the year, if not throughout 2025, which means that default rates for corporate bonds is likely to stay low. And therefore, with high yield corporate debt at around 7%, 8% yields, that to me is reasonably attractive.
So you're seeing another year of U.S. exceptionalism when it comes to the strength of the economy. What does that say for the equity markets when valuations are so high already?
Well, I think there's going to be a broadening out of the U.S. equity markets. Last 2 years, frankly, has been driven by the tech sector, the Max 7. But I think this year, where the growth momentum is starting to build, you are starting to see better earnings momentum on the other parts of the economy. And again, if we come back to the AI theme, the question of whether a cheaper AI costs can help non-tech companies to make use of this technology. So you could look at financial services, healthcare, consumer services. I think these are the sectors that can benefit from cheaper AI technology. And at the same time, because the tariff that we've discussed just now focused largely on goods, again, these service sectors not completely immune, but certainly they could enjoy a bit more resilience.
Taihui, really good to have you with us and also see you in person after all these years. In fact, Chief Market Strategist at JPMorgan Asset Management joining me here in the Hong Kong studio. Take a look at how automakers are trading across the session in Asia today. Of course, we have heard from President Trump that the tariffs on car makers could come as soon as April 2nd. And we do know that imports accounted for roughly half of the U.S. car market last year. And you're seeing Kia and Hyundai really lead those losses in the Korean session. For example, when it comes to Hyundai, we also know from global data that 65% of Hyundai Kia's U.S. sales are imported. So we'll continue to watch these names as we see the trading session unfold across Asia, Haidi.
We're still ahead. Shery, China's Foreign Minister Wang Yi tells officials at the Munich Security Conference that his nation will resolutely respond to U.S. bullying. We'll take a closer look at the rising tensions with a geopolitics expert.
But up next, our exclusive interview with German Chancellor Olaf Scholz, who says Europe is strong enough to react to U.S. tariffs but prefers to avoid a trade war. This is Bloomberg. German Chancellor Olaf Scholz says the European Union is strong enough to stand up to President Trump's tariff threats. Even so, Scholz tells Bloomberg exclusively that the EU is open to talks to avoid an all-out trade war.
I have to admit that I'm in favor of free trade. I think this is a big advantage we have in the world, and that many of the wealth and the growth we have in the world is because of free trade. So it must be fair free trade, yes, but free trade is better than tariffs and protectionism. I don't think that this will work.
So it should lower tariffs?
When it comes to the European Union, I think everyone knows that we are a big economic area with a lot of strength, where policy about tariffs is something that is our common policy. So we are strong enough to react to everything that is harming European economy. But we should react always, but in a way that is always offering the chance for an agreement, because it's better for all parties involved, especially on both sides of the Atlantic.
But is the European Union considering cutting tariffs before any announcement on cars?
We invite the United States to discuss with the responsible authorities about what we can do for a better progress that serves all of us. There is a willingness. And so I'm sure it's better if we agree to something that helps all of us. And it is good to know that Europe is strong enough to act and to react.
You talk about it being a common project, but Donald Trump has made clear that he wants to do reciprocal tariffs. He doesn't want a WTO approach where all the rules are on the same countries. And even with the European Union, he might want to have a different tariff regime for France and Italy and Germany. What would you do then?
The European Union is a unified economy and has...
but there's nothing to stop the US doing that.
But it has common tariffs, and we act together, and we will stick together, which I think is also important. And so I'm quite confident that a good solution is feasible, and everyone should work to make it happen.
German Chancellor Olaf Scholz speaking exclusively with Bloomberg's head of economics and government, Stephanie Flanders. Well, President Trump says Ukrainian President Vladimir Zelenskiy will be involved in peace talks with Russia. That's as senior US and Russian officials prepare to meet in Saudi Arabia to discuss a potential leaders' summit to end the conflict. Let's bring in Bloomberg News editor Michael Haidi. So we don't know what this involvement looks like.
Yeah, well, that's exactly right, Heidi. I mean, it's good that President Trump did say that, because some of his aides and more junior people had been demurring. They hadn't given a set answer, and in many respects in the Trump administration, until the president says it, you're really not sure what's going to happen. So on that side, it's positive. But yes, I mean, just as you mentioned, they're meeting in Saudi Arabia, US and Russian officials, to try and sort of set the parameters for talks, and Ukraine doesn't seem to be involved in there. Europe and Ukraine sort of seem to be among the last to find out what's going on there. So it's a real period of uncertainty and probably quite high stress for President Volodymyr Zelensky from Ukraine. But you know, he at least does have that assurance. So we're just sort of going to have to see how that unfolds. We obviously had President Putin and Trump speaking last week. President Trump also said that Putin had told him that he didn't want to push Russia's advance further and was sort of ready for talks. And Trump seemed quite pleased by that. But I think these are sort of comments that you take with a grain of salt. I mean, really, the last US president who thought he'd built some sort of special rapport or relationship with Putin was George W. Bush, and that sort of ended in tears in the end. So really, with Russia, you've got to have things on paper, in print, and you've got to be backed by force as well.
In terms of what we're seeing with the sort of, I guess, stepping up of Europe, right, from a strategic, from a security, military point of view, is that also the reaction to what Trump thinks that Europe should be doing more, just like he thinks that Middle East nations should be doing more when it comes to Gaza? Yeah,
and look, I mean, I've sort of repeated this. I think the US has a really fair point here. They've been subsidising European security for 80 years, and Europe does have to step up. But the problem also is that this demand from the US comes against the backdrop of a war, which the US might pull its support from Ukraine. We're sort of not sure what's going to happen there. So it's really got a sense of urgency about it. President Macron of France has convened a meeting. The UK is saying it's prepared to put boots on or potentially prepared to put boots on the ground in Ukraine as part of any peace settlement. So there's a real sort of sense of urgency there, and Macron's bringing together the countries in Europe that do spend fairly seriously on defence or have the economic capability to do that. So that's going to be quite interesting to watch. But whether there's anything that comes out of it today is unclear, because Germany obviously has an election coming up, and the last thing they want to do, the right-wing party in Germany is sort of fairly sympathetic to Russia. The last thing they want to do is talk about big defence spending and drive German voters into the arms of the right there. So it may be that they sort of set the parameters themselves and then talk after the election. But Europe struggles to do things quickly, and that's the problem. The Trump administration is moving very fast. I mean, there's talk off the record, officials cited off the record, saying that the US wants a deal by April, which is just under 9 weeks. By Easter, which is just under 9 weeks away, and that's going to put the Europe under a lot of pressure.
Yeah, the Trump administration wants also Ukraine to move pretty fast when it comes to paying it back for its support against Russia, if you can sort of call it that, given that they're not necessarily part of the negotiations, it seems, so far. But could we see the potential minerals deal that has been offered?
Yeah, well, I mean, Shery, it's a really interesting one. I mean, President Zelenskiy has so far basically rejected this suggestion that was put forward by the Treasury Secretary last week. And from the outlines that we're aware of, that was sort of talking about the US getting 50% of revenue from the mineral licenses, the critical mineral licenses that Ukraine sells. Now, Ukraine wants more than that. I mean, it wants some sort of security tie-in from the US. It would like US investment in developing those critical minerals. So it sort of wants a bit more. I mean, what the US is proposing is very one-sided. It's very good for the US, and there's sort of this reinforcement that Ukraine owes the US for all the arms and support it's provided, which to some extent it does. But in a sense, the Trump administration is missing the point here a little bit. That the reason those arms were provided was so that things were held up in Ukraine. I mean, if Ukraine fell, then you're going to start to have problems in the Baltic states, potentially all sorts of areas. So it was a bit of a US investment there. But we'll have to see how that unfolds. I mean, Ukraine's bargaining hand is not terrific here. But Zelensky certainly has the population behind him. No one in Ukraine wants to be sold out here. No one wants to be in a situation, dare I say it, of Munich in 1938 with Czechoslovakia. I mean, they want Ukraine to be involved and they want it to be fair, but they also want peace. I think everyone here wants that as well. So we just have to see how this unfolds. Very interesting times.
Bloomberg News editor Michael Heath there breaking down the geopolitics around Ukraine and Europe, of course, as investors have been digesting all of that news, not to mention, of course, the tariff threats. Take a look at how European futures are setting up early in the Asia session. We have seen already European stocks retreat from record highs, but still put it into context because we have seen a very strong rally for European stocks this year, about 9% already. We had some solid earnings season. We had the stock 600 gaining for 8 consecutive weeks, the longest winning streak in more than a year. So right now, a little bit of a mixed picture, but of course, a lot of uncertainty out there for global markets. We have more ahead on the Asia trade. This is Bloomberg. PBOC Governor Pan Gongsheng says that China's economy is sound, but price growth and consumer demand can be stronger. He added that the country will adopt a more proactive fiscal policy and a more accommodative monetary policy. China has seen persistent deflation as officials pledge to open up the economy, advocate for free trade, and maintain a stable currency. Major U.S. banks are scaling back investments and cutting jobs in China as trade tensions between the two nations mount under President Trump. Meanwhile, the new U.S. investment rules on sensitive technologies like AI formalized under the Biden administration have come into effect. Senior finance reporter for Asia, Kathy Chan, joins us now with the latest. And Kathy, of course, we have seen a series of measures coming from Washington on Beijing. So what are these new investment restrictions that are affecting these Wall Street giants?
Hi. Yes, the earlier sanctions are focusing more on specific entities and individuals, but now these rules, which is called OIR, Open Investment Rule, they are now focusing on the entire sectors. The previous laws in U.S. is overseeing Chinese transactions is CFIUS, which operates more like a review of transaction. But these new rules could be would be actually prohibiting things from happening. So the sources are telling us that there are lots of legal complexities and a lot of ambiguity surrounding the scope of the certain investments. And people are particularly confused about which companies fall under the AI category. So the bankers said they need to test the waters by attempting different deals or observing whether the competitors can get similar deals approved before they pursue similar mandates. So the rules are definitely going to slow things down and have a chilling effect on the banks.
And Wall Street banks haven't seen much benefit after 5 years of the financial opening up for China, right? Has that impacted their strategy going forward?
Yeah, actually the banks they don't have any real strategy right now in China. After spending so much money, spending billions of dollars to invest their business onshore, the signs of retreat are actually growing, especially over the past 2 years. Everyone just kind of cut to the bone, maintaining the minimum operations, minimum staffing required by the Chinese regulators. They're not going to exit China, but there's no strategy. There's nothing happening in China. I mean, except what they do right now is to keep their heads down and basically have a very passive strategy of minimizing costs, avoiding risk, leaving little room for any bold moves or strategic moves.
And yet we have seen a very strong market rally in China for the last 2 weeks. So could this be a fundamental and significant shift going forward?
I think the recent rally is just too soon to say whether it will shift the direction of banks in China. But I think equity business, the equity trading business, could be a bright spot for this year. Morgan Stanley and UBS already have seen their Chinese equities revenue, the trading revenue, rise by 20% last year, thanks to the stimulus measure China announced in October last year. So the volatility is expected to be a key theme this year, especially with the Trump administration. This is likely to boost the equity revenue for global banks in China. But overall, the executives said they are still very doubtful about the economy in China. So they're still very concerned overall the deal-making and other businesses.
The sort of situation when it comes to IPOs hasn't really helped either, right? Do we see much prospect for improvement?
For IPO and deal making, I think this year is likely to be better than last year, partly because the valuations of these Chinese companies seems to have come up a little bit. But people are generally don't expect a big jump. I think some banks are forecasting 10% revenue increase, but they said this budgeting is no longer kind of relevant because China is so volatile these days. They just cannot budget like how much revenue they can get, especially from deal making. So it kind of tells you how uncertain the environment is going to be in 2025 for them.
Senior finance reporter for Asia, Kathy Chan, there with that story. Well, as we look ahead, of course, to the start of trading this Monday in Greater China, take a look at the markets that are already online, and we are seeing sort of a mixed picture, but generally that tone of caution, even as we see really modest upsides for the likes of the Nikkei 225 as well as the Kospi, just trading under about 0.1% each. Perhaps a little bit of enthusiasm when it comes to Japan assets today, given that we did see that beat on the GDP numbers, as well as, of course, some heat in the CPI reading last week there as well on account of the rise that we see in food prices. Here in Australia, we're seeing off about 0.7%. Their financials dragging Westpac, one of the biggest laggards there after that trading update failed to impress. But broadly, quite a bit of risk aversion ahead of what is a big week for the RBA.
And we have breaking news out of Singapore. We are getting the non-oil domestic exports year-on-year contraction of 2.1% for the month of January, when the expectation was for a little bit of growth. And it's also a contraction from 9% growth in the previous month. We're talking about the first contraction as well since the month of October. And of course, this is a very export dependent economy. Electronic exports year-on-year growth of 9.6%, which seems like a big number, but the expectation was for double that of more than 18% for the month of January. So we're seeing these export numbers coming from Singapore surprise to the downside, Haidi.
Well, Shery, Singapore's defence minister believes that the US-China rivalry is the main geopolitical focus in Asia, but neither country wants to go to war over Taiwan. Speaking to Bloomberg on the sidelines of the Munich Security Conference, he also said that the US under Trump is unpredictable in a way not seen before.
I've been talking to European leaders. Everyone agrees that the peace process needs to begin, and peace is a good idea for everyone. What's unsettled is security guarantees for Ukraine and how to make sure that the aggression that Russia showed isn't repeated after the peace ensues. And for the impact on China, American policy has always been that, quote unquote, China is a pacing threat. And in terms of disposition of forces, the U.S. already pre-positioned more troops and assets into Asia. So that isn't really very different.
But can you give us a sense of how you're interpreting, his latest comments or what we've heard so far on Taiwan and the South China Sea?
I think neither U.S. nor China want to go to war over Taiwan. I think the U.S. recognizes that Taiwan is a deep red line for China, and we're in a better position, I think, when we were compared to 1 or 2 years ago. For South China Sea, we have to be careful, but I think there is less reason for casus belli. So I think if heads hold on steady and we agree on a modus vivendi, a sort of accommodation, and hope that time will ease the passage of both big powers, I think that's not a bad position.
Are you more optimistic or more pessimistic than you were 3 weeks ago after all the current developments?
It's certainly unpredictable. I think the biggest question on everyone's mind, and this is from the conversations I had with European leaders, is how U.S. has changed. It is now in the 60s and 70s, even for Europe and Asia, the U.S. was portrayed as a liberator, whether it's against Hitler's Nazis party or communism or other forces. Now U.S. is seen as a great disruptor. And how do you come to terms with new conditions? There is certainly a level of unpredictability that hasn't been seen before, but one hopes that that doesn't lead to instability.
That was Singapore's defense minister speaking to Bloomberg's Francine Lacroix. Now, the director of the China Center for Economic Research, Yao Yang, says the best way to rebalance trade between the world's two largest economies is for more Chinese companies to invest in the United States. Speaking on the sidelines of the Munich Security Conference, Yao told Bloomberg that he hopes that China's President Xi and President Trump will negotiate a deal that would avoid a trade war between the two nations.
But the best way to balance the trade is not to use tariff. It's probably for Chinese companies to invest in the United States. So Chinese companies don't need to export to the United States, but instead they're producing in the United States, right? So this is going to create a win-win situation for both countries.
Joining us now is Josef Gregory Mahoney, who's a professor of politics and international relations at the East China Normal University. Professor, really great to have you with us. And of course, we're also watching and listening to what Foreign Minister Wang Yi had to say in Munich as well. And I thought it was quite interesting. There were almost sort of hints of that 2017 Davos speech that we had from Xi Jinping. Are we again seeing Beijing, being able to, through the actions and policies of Trump 2.0, kind of try and position itself as the bastion of multilateralism and to an extent even liberalism within the global economy?
Well, several years ago, before Trump 2.0, I was discussing with a senior colleague from Europe, why has the EU remained so committed to the U.S. despite U.S. declines from Trump 1, but also during the Biden administration, which have led to deepening security and economic traps vis-a-vis Washington, despite perilously impoverishing relations between the EU and the U.S. And he asserted, seriously impoverishing relations between the EU and Russia and China, and making those traps worse. And he asserted that the EU-U.S. relationship fundamentally was one of first principles, namely that liberal democracy, however imperfect in practice, is the ontological foundation of key European states and the EU itself, in tandem with the fundamental faith in the perpetual capacity of liberal democracies for self-renewal, and that these weren't simply abstract values, but central to the real politics of holding growing European right-wing and ultranationalist movements at bay, and likewise for holding the line against authoritarian me-first, me-last nations like Russia, he argued, that eschew liberalism in their domestic and international affairs. Now, what's been horrifying, I think, during this conference in Munich for so many in Europe is that their worst fears about Trump's return appear to be coming true. First, that the rules-based system of both trade and security matters appears in tatters, with increasing tariffs and economic coercion underway, and even threats of military coercion against allies and adversaries alike. Second, that the U.S. is meddling directly and openly in the domestic politics of several countries. This is a point made by the leading candidate to become the next chancellor in Germany, with the Trump administration supporting conservative and, where possible, right-wing political parties and movements, with Vice President Vance courting the AfD and castigating European governments for suppressing right-wing movements while not confronting, in his view, the greater risks associated with immigration, which he said pose greater threats to European democratic values than Russia or China. And, this predictably drew strong responses from Berlin and Paris, who are both fighting domestic right-wing movements that could imperil the entire EU project if they prove successful. But the third point is that Trump appears ready to move ahead with a peace deal with Russia that would exclude Europe and possibly even Ukraine. And this has been likened to appeasement of Trump conceding to Putin as Chamberlain did to Hitler. And it's in these contexts, to answer your question, that we have Wang Yi making this speech and returning to this principles-based concept of foreign policy that China has been promoting for several years as the alternative to this this collapsing U.S.-led international liberal system.
Do you think that's a viable alternative? Do you think there is actually, a room for opportunity for Beijing here, despite, of course, the overall threat to global trade and to, its trading relationship with the U.S.?
I think the reaction that we're seeing from Europe is that Europe has already raised or nearly raised its contribution to defense to 2% of GDP, and they're going to aim for greater than 3% to bring it in line with what the U.S. is currently holding at between 3 to 4% of GDP. And we see Zelenskiy arguing for the need to create a European army, one that won't be reliant on the U.S. Going forward. So it's not clear that this represents a clear opportunity for China to improve relations, that Europe is thinking about how it needs to go it alone, perhaps, or be prepared to do so. But the fact of the matter is that Europe is rather far behind, and the way that they have to balance 27 different nations in their decision-making means that they have a severe disadvantage in terms of geostrategic competition, whether it's with Russia, China, or the United States.
And yet, Joseph, we saw President Trump's first term in office, right? We knew what his views were on Europe. We knew where he would stand when it came to Ukraine and Russia as well. In a way, we could guess where he was going to head in terms of policy. Could Europe and Ukraine have done better in setting up for what's happening right now?
I think that's clearly the case. I think that they were led down the path by Trump initially with the threats to NATO, and then Biden, of course, expanded NATO and made Europe even more dependent on it. Now, to Europe's credit, they did increase defense spending, but they also made themselves more reliant on the U.S. For financial and military security, especially after they cut their access to Russian energy. So they raised their contributions, but they also saw severe economic cost associated with those strategic decisions. And I think they find themselves overall in a diminished position and even more vulnerable to the right-wing movements that the Trump administration now wants to cultivate in their countries.
How much is all of this really sucking the attention of the Trump administration and broader U.S. policy at a time when, of course, we continue to have the issues around Gaza, not to mention, as you point out in your notes, in West Africa as well?
Yeah, I think that these were what's interesting is that we have this security conference, and of course, what we really see is a lot of, I don't want to go so far as to call it, white privilege or a Eurocentric worldview, although I think that's clearly something that we should anticipate in a conference held in Europe. But the fact that Gaza and the problems in West Africa and the Sahel were absent from the conversation, and likewise the growing existential crises associated with climate change, which in some respects touch on nearly every problem that we face today, the absence of these discussions really, I think, underline the general failure of this conference to address some of the real issues facing real people right now.
Josef, Gregory, Mahoney, really good to have you with us, Professor at East China Normal University. We have more ahead on the Asia Trade. This is Bloomberg. Hedge funds have been piling into Chinese equities at the fastest pace in months as bullishness on the DeepSeek-driven technology rally adds to hopes for more economic stimulus. For more, let's bring in our China correspondent, Mingmin Lo in Hong Kong. Mingmin, so we're finally seeing this rotation back to China, but I guess always the question is, how long can this last?
Yeah, it's interesting because you have the likes of Deutsche Bank saying that this is a Sputnik moment for China, although some analysts will say that that is taking the rally too far. But DeepSeek has been able to do what multiple rounds of government stimulus and even national team buying had failed to do, which is to push the Hang Seng Tech up above the October peak. And there is now this sense that China has shattered expectations that you would need the sort of very cutting-edge, expensive hardware from the likes of NVIDIA to be able to have breakthroughs and disruption in the tech innovation sector. So investors are piling into the stock market, hedge funds longing a lot of Chinese equities, and this is coming at the expense of India. If you look at the chart there, China's MSCI China beating India for the third consecutive month, which is not something we see very often in the last couple of years. Valuations play a part as well because MSCI China is trading at just 11 times forward PE versus India's 21 times. So that's another factor, and also concerns around India's macroeconomic slowdown, corporate earnings slowdown, and it is interesting to watch what China's relationship would be with the private sector going forward, given that presidency is going to have this meeting with the tech titans today.
There's a lot of chatter when it comes to this meeting that presidency is having with Chinese tech leaders.
Yes, and it's hard to say what they might discuss, but we know that this is a symposium, according to Reuters, to boost private sector confidence. And the first time that presidency held such a symposium was back in 2018, where he then announced pledges for tax cuts, financial backing for these companies. So it is possible that we could see a slew of measures that are released at the end of this meeting. We'll have to wait for lines on that, and it could have the potential of being yet another catalyst for this tech rally. And I guess symbolically, it also is very significant given that Alibaba's Jack Ma is attending, and he's arguably that very prominent face that has suffered under years of China's tech crackdown. The fact that he, for a long time has shied away from the media, and now he's sort of gradually stepping back into the spotlight, suggests that maybe this is the culmination of years of crackdown, and maybe China actually recognizes that the source of all these domestic innovation and disruption comes very often from the private sector, and they need to change their stance towards private companies.
Bloomberg's China correspondent Mingmin Lo there. Well, HSBC and Standard Chartered are set to report earnings this week, with Bloomberg Intelligence expecting Hong Kong banks to deliver stellar 2025 profits on greater cost-cutting measures. Let's bring Bloomberg Intelligence senior analyst Matt Ingram for more now. So a lot of weakness going into this.
Yeah, look, it's interesting, Heidi. I think people expected the Fed to cut a lot this year, and they haven't. And so HSBC and Standard Chartered, two very sensitive banks to margins. HSBC less so now that they've hedged some of their duration risk. But I think people were surprised. The Fed really hit the brakes, and that's very, very good for those two banks' earnings.
Buybacks are always in focus, right? What can we expect?
Yeah, they're both extremely well capitalised. They've both got programs ongoing. We think that probably HSBC is well placed to announce another one with results, but certainly both should pay a lot of money back to shareholders this year.
What about the chronic threat of tariffs coming from the Trump administration? Will this affect the pair?
Yeah, Shery, it's a really good question. Obviously, front and centre in the news cycle. Asia growth should be impacted and could be impacted a lot. Globally, not as much, but given these two are both very overweight in that sort of China and Hong Kong region, it's going to hurt them. The question is how much, not yes or no.
We had that solid quarter for Wall Street banks. Will this have implications for these companies here?
Yeah, volatility is obviously a big driver for trading profits. We didn't see that with Macquarie here in Australia, but certainly our expectation is for the Hong Kong banks. The volatility is great for FX hedging, it's great for rates hedging, and those are areas where these two are strong. So there should be good results coming out of the investment bank.
Matt Ingram there, good to have you with us. Bloomberg Intelligence senior analyst on bank earnings. And here in Hong Kong, we're also watching, of course, distressed property developers in China facing a torrent of court hearings here in the city this week. Several companies, including Tianji, HNA Group and Sino-Ocean, have liquidation hearings scheduled. Bloomberg's China credit reporter Loretta Chen joins us now. Tianji is a key unit of China Evergrande. So what should we expect from this hearing?
Yeah, well, it's been a year since Evergrande, the mother group, has been liquidated in the Hong Kong court. And since then, the liquidators have actually moved to pursue all these offshore units of the company. And there's, dozens of them. And we actually have seen another Evergrande unit last year that's been liquidated that was related to the mother group liquidation. So there is an expectation that this company will eventually get liquidated because there's not much argument to really back the company side in terms of how a non-liquidation could help to the benefit of the creditors. And I think liquidators are just one by one pursuing these companies, and we're seeing that it's a really prolonged process.
So what are we seeing then? What are the implications for China Evergrande broadly?
Yeah, more broadly, we're just going to see the company really being dismantled one by one. But again, it's a very difficult process because we're talking about offshore units. And we know that most of the company's most valuable assets are still onshore. So for the liquidators to liquidate the offshore unit, they still need to find a way to reach to the really valuable things that are in mainland China. So it's just a piece of the puzzle that they're doing here. So, a long process ahead.
Sino-Ocean's winding up hearing has been adjourned. So what do we know in terms of the debt restructuring process now?
Yeah, so Sino-Ocean is a high-profile state-linked developer that has defaulted in 2023. And we're really seeing the restructuring process of the company accompanied by a lot of resistance from a creditor. So one of the creditor groups is Long Corridor, a hedge fund based in Hong Kong. They've been really vocally opposing the company's restructuring plan. So earlier this month, a UK court actually approved a restructuring of the company. Meanwhile, the company is still facing a winding up hearing in Hong Kong. So the hearing has been adjourned to April, and we don't know, to what extent the company has actually reached agreement with all of its creditors, or will it really face opposition from a small creditor, and that could really increase the risk of, another court hearing just ongoing here in Hong Kong.
Bloomberg's China credit reporter Loretta Chen there. Let's get you some of the other corporate headlines that we're following this hour. Bloomberg has learned that TSMC is considering taking a controlling stake in Intel's factories at the request of Trump administration officials. Sources tell us that the deal would have TSMC fully operating Intel's US semiconductor factories and would address concerns about Intel's deteriorating financial state. TSMC is said to be receptive to the idea, but it is still unclear whether Intel is open to a transaction. Elon Musk's AI startup xAI will release its Grok 3 chatbot with a demonstration on Monday. In a post on X, Musk described the product as the smartest AI on Earth. Musk has said that the model can reflect on mistakes it makes by going back and forth through data. Grok 3's debut comes as more and more competitors emerge to challenge OpenAI's ChatGPT. Bloomberg has learned that Apple is planning to add AI features to its Vision Pro headset as it seeks to boost interest in the device. Sources say it's aiming to roll out the upgrades in April, along with an updated mode for guest users and a spatial content app. Apple is expanding Apple Intelligence to the headset just as Google announced its mixed reality operating system that integrates its Gemini AI. More to come here on the Asia Trade. This is Bloomberg.
We're seeing some big moves on reaction to earnings results across Japan. Sanrio seeing its best day since August of last year, now trading at the highest on record after they boosted their operating income guidance for the full year, which also beat the average analyst estimate. Olympus, though, declining the most in about 18 months or so. This as they cut their full year operating income forecast. They missed estimates, sort of a similar picture with Dentsu, which the operating income forecast also missed estimates, down about 12% at the moment. And Rakuten also falling today, the most since December. The company reporting their 18th straight quarterly net loss, even as their mobile business improved. Heidi.
Take a look, Shery, at what we're watching when it comes to the futures picture. US futures continuing to see a little bit of upside, of course, despite the ongoing trade tariff tiffs and geopolitical concerns as well. We're seeing investors continuing to pile into US risk assets, with the S&P 500 really pretty close to that record high last week. Taiwan futures also looking like we'll see a bit of a pop. We'll be watching TSMC with this reported engagement with Intel. And when it comes to China stocks, that's the last traded number when it comes to A50 China futures, but really it is those Hong Kong listed stocks that we're watching, with the China Enterprises Index as well as the tech stocks on the Hang Seng Index overtaking their October peak last Friday. We're watching just about 0.5% away from the broader Hang Seng Index to do that as well, as it continues on that 5-week winning streak, the longest since January 2023. That was, of course, the post-pandemic reopening there, as we see this China stock rally continuing to be driven by AI. This is Bloomberg.